All right. Welcome to Be the Market Expert. And wanted to kick it off with this. This was actually this was actually a tweet that went out. And fast forward, it's oh, I lied. This isn't that one. That one's next. Let's look at this thing though. So this is the housing market is being transformed by lifestyle delays. We've had this conversation a couple times, right? Like I feel like we pulled this up and but I think what's interesting, what's important is that this should, like, as we're looking at this information, and there's these two graphs that we're going to look at. I think that what we need to keep in mind is what this information is pointing to is firstly how we should be curating our conversations and who are the demographics of people that we should be keeping in mind as we're going forward. And this is what I mean by that, right? I have conversations, obviously, as the team leader for the brokerage, and some of the conversations that I have is, with agents and how they build their business, whether it's our top agents like our ALC, or it's a brand new agent entering into our space. Like, how do you want to, or how are you building your real estate business? And it's interesting because a lot of the conversations that we have, I think it's obviously around comfort level, but I think what's also important that we need to keep in mind is like who are the people buying and selling real estate? And especially on the buy side, right? When we start thinking about this, we're in an interesting position as far as our economy goes right now. We're in an interesting position in the sense to where money's not cheap. And that'll be on our next tab that we look at, where the firing the shots across the bow. But let's look at this thing, right? It says one of the bigger underlying forces reshaping the US housing market is the lifestyle delay phenomenon. As younger generations are pushing traditional life milestones further into adulthood, staying in school longer, marrying later, and having children later, and often having fewer children overall. All right. So firstly, I don't think any of that is breaking news, right? Like none of that is coming across any of your televisions as, hey, you didn't know this, and right. We understand a lot of these is because, well, we have generations that are going through school and they're realizing that life's expensive. And so they're like, okay, well, should I keep leveling up my degree? And hopefully, if I get my degree high enough, that I will be able to go and get a better paying job. Especially as you look at this, guys, like, I don't know. So my wife, right? My wife works for Excel Energy. She's an analyst, and she's not the person that raises your rates, even though if we were at a party, that's what I would tell you just to get a reaction out of everyone. But yet she looks at, like, should we retire more coal plants? Should we be bringing on more green energies and renewables? And like that's what she does. And she looks at like the makeup of the areas and figuring out like what should be happening for a couple different states. And yet in that industry, it's funny because we'll look at job postings together, and a lot of the job postings is like you either need to have 100 years of college and or 30 years of experience. And it's like, and I think that's where a lot of these people are right now. Not necessarily 100 years of college, but yet they're in a place where if they can't go out and get real world experience, they need to get from somewhere else. And that's where the schooling comes in. And I think that's what we're seeing, right? We're seeing, well, if I want a good paying job in the sector that I want to work in, I either have to either go get an internship and live in there and hopefully level up through the internship and move forward, or I have to go through school. So that part isn't strange to me. Then the marrying later and having children later, right? Like, I think, yes, absolutely. And because I think with the cost of living, what does it look like? Well, I can either get into a rental property, and especially in the state of Colorado, right? We're talking about what, $3,000 a month is my rental. So then am I moving into a rental property with my significant other, or am I going to house hack it with a couple of roommates? And I would say most of the time it's probably house hacking, especially when we're talking about younger generations. We probably have 3, 4 different groups of people living under one roof, and they all have a bedroom. And then obviously with that comes having children later. Like none of this is surprising, right? None of this is like, oh God, like I get it. So let's look at this median age at first marriage. Okay, so let's think about this just historically speaking. What happens is you grow up, everyone's with me, and then you go to school, get a job, whatever that may look like. Then you meet your significant other, you get married, you buy a house, you have babies, right? Like that's kind of what it looks like, right? The overall overarching theme, and I get that doesn't look exactly that same way for everybody, but yet this is what this is telling us, right? The median age. And so we got to keep in mind median. This isn't the average. This isn't all of it divided up. This is literally taking out all the outliers. This is taking out the people that are getting married at, in their 20s, right out of college. And this is getting where we're talking about people that are, in their 40s, right? Maybe 50s, right? It's taking out all the outliers and it's making its way into that middle number and saying men are getting married at 30 years of age right now, which is about the same, right? If we were to look at this thing, let's see if I can shrink this a little bit. There we go. That looks the same, right? 30 and a half, almost 30 and a half, lower 30s. And it's saying women, well, they haven't changed much either. They're at 28, almost 29, back to 28 and a half. And I don't think you can call someone 28 and a half, right? I feel like I should, figure out how many months that is and be like, oh yeah, they're getting married at 200 months. But that's what this looks like. So again, when we look at this demographic, get married, have children, need a bigger space, that start thinking about life, right? Like this is what this looks like. So when I'm looking at this graph, and I know that, again, historically speaking, I'm not saying this is the same story for everyone, but you get married, you have children, and you start moving forward with the rest of your life. What does our marketing look like? What is your marketing collateral? Where are these people? Are you around these people? Are you around the 30-year-old first time getting married people? Like, are they in your ecosystem? Are we advertising on social media? Are we on Facebook? Are we on Instagram? Are we on TikTok? Are we doing YouTube shorts? Like, what are we doing where we know these people are at least on social media? And then are we at the same places where we might bump into this demographic? And again, like we can see this, like it's gone up, but this is kind of where it lives. So then we fast forward, we rewind it a little bit. So this is where we're starting taking the first mind share. They're in their 30s and they're getting married. Well, again, get married, have babies, life. All right. Like that is historically speaking, traditionally speaking, that's what this looks like. And again, not everyone's the same. But it says delaying marriage and parenthood often means delaying their first time home purchase. Historically, getting married or starting a family has been a primary trigger for buying a home. Yes, I would say that's still the thing, right? Historically speaking, you get married, you start having children, you buy a home. Well, now it looks like this. So they're getting married at 30, again, median age, taking out all the outliers. And now they're almost 40 years old. So again, 40 years old, that's an older millennial, right? Maybe not an older millennial. I feel like that's where I'm getting close to as well, but that's your millennial home buyers now. So median first-time home buyers, 38 years of age. What information are we putting together? And guys, if you think about this, like what does your marketing collateral look like? Like, let's think about this. If I'm going to go through and I'm going to create some stuff, maybe on Canva or insert whatever else here, does my first-time home buyer look like a 40-year-old? Or do they looking older? Are they looking younger? Like, how are we taking this mind share? My listing packet, my listing presentation, my buyer presentation. Are we going through? Are we curating things that are open houses where we're like, oh my goodness, like these are our first-time home buyers. That 40-year-old that's walking into your open house, this could quite possibly be, looking at the numbers, their first home. And are you talking to them in a language that makes it seem open and inviting and inclusive to them? because that's truly who our demographic is. It says, sure, some of the recent jumps in the median first-time home buyer can be attributed to the sharp housing affordability deterioration since 2022. But it's also pointing to some lifestyle shifts, right, when we look at this. But I would also say that I do think it's the cost of living and being able to afford life. I do think that they're all directly correlated and very, very closely, right? Where if I want a high paying job, I either need workforce experience or I need the education. I'm staying in school longer. I'm saving my money. I'm probably living either, in my parents' house still, or I'm house hacking with a bunch of my buddies. I'm waiting in. I find someone that I want to spend the rest of my life together. Then we may have kids. We need to go purchase a house at this point. Like, this is what it looks like. What does our marketing look like? What are our conversations? It says, what actual steps can housing stakeholders do to benefit from this secular shift? It says, from a business standpoint, don't fight the trend. Today's housing market isn't going to suddenly revert back to the 1970s or the 1990s when large number of 20-somethings were entering homeownerships. Demographic and lifestyle shifts mean the younger buyers are entering the market later. So again, is our messaging curated to a 40-year-old? Agents, builders, investors should pay close attention to the preferences of affluent something-year-olds and increasing affluent 40-year-olds. This group now represents a significant share of first-time home buyers. Okay, cool. So we're saying that if I want to double down and the laws of statistics, then what am I doing to position what I am doing to the 40 and the older 30-year-olds, because these are the most of the demographic that is purchasing homes. And it says there's a rental opportunity to serve late 20-year-olds and 30-year-olds, which doesn't excite any of us in here because we live in Colorado and that market looks way different. But yeah, what I would say to this is, what would it look like? Let's just say I did want to double down on this. I wanted to say, okay, cool. I know that they're going to go have a rental, then they're going to meet somebody, they're going to have kids, and they're going to go buy a house. What does it look like to go and just start marketing to absentee owner list, where we know that it's just the rental market and I just have a farm, a geographic farm in some of the hipper, trendier places, right? Like maybe I'm going to say like Wash Park, affluent, and I'm going to go after the absentee owner list, go get that from Land Title and just start marketing to these guys. Then what does it look like to start building my Facebook to where I start building on it? And if I really wanted to double down, what would it look like for me to go figure out where I can go get some open houses in that neighborhood specifically and really just start getting in front of as many of those people as possible? So, guys, I think this is interesting. These are interesting numbers. Like, I don't think any of this is truly surprising to us, but I do want to look at it from a perspective of what are we doing to advertise? Now, here is the tweet that I was talking about. It says the FHFA director calls out Powell, lower the interest rates. Now, firstly, I think what's important to keep in mind, I was having this conversation with my dad on Friday, is that none of these people work for one another. Like, they might be in the same building at times, they might know who one another is, but none of them have a direct line to the other one to where they can do anything about any of them, whether it's the president or the Fed or the FHFA director, who is just the person that looks at money and being able for any federal backed home loans. None of them impact one another. But what they're hoping to do, and this is going to be a conversation, we saw this back in 2017, and we're going to see it again now. The only thing that they can do is they can point the finger and they can be the loudest person in the room. And that's truly what they're doing. It says on Monday, FHFA director called out Powell, and this was his tweet. It says, Jay Powell needs to lower interest rate. Enough is enough. President Trump has crushed Biden's inflation, and there is no reason not to lower rates. The housing market would be in a much better shape if Powell does this. Okay, first and foremost, I don't think any of us disagree that if interest rates came down, then we would sell more houses. And I don't think that anyone feels any differently about that. And yet this is all these guys can do. And so Powell will shoot back, like he'll shoot another shot across the bow. This is what we have. We have the current administration that is saying we have issues because the rates are what the rates are, and Powell needs to lower them. All right, that's the administration, right? That's the president's stance. And then on the other side, we have Powell and the Fed presidents, and they're saying, listen, we have financial uncertainty because of tariffs. And we're not going to do anything until we know where this whole thing shakes out. Okay, so we have two totally different sides of the aisle, right? These guys are far, far apart. And here's the thing, neither one of these groups can fire the other one. I mean, yes, there is a world where Trump could fire Powell, but it would be for gross negligence, and that's just not where we're at. So yes, there is a provision in some document somewhere that says Trump could fire Powell, but it's for gross negligence, which Powell's not doing. I mean, yes, we're in a real estate recession, totally get that, and real estate isn't selling as quickly as it was, totally get that, but yet he's not really doing anything to hurt the economy. And so that's the only basis that Trump would have to fire Powell. So outside of that, these guys cannot do anything to each other. So what can they do? They get on Twitter. Like literally, that's all these guys can do. They can do press conferences. They can get on social media platforms. I don't think any of them have a blog, but if they did have a blog, I guess they could blog about it. But yeah, like that is literally it. So we're going to continue to see these things kind of fire back and forth. And they're going to figure out, right? They're going to look at, jobs. And so like this, and we've had this conversation, right? All employees, residential building construction. We talk about, at least in most of our conversations, we talk about overall jobs, overall employment. And yet what we do know is this: the residential building construction side will truly be the sector that gets smashed against the rocks first. And the reason for that is because this is the sector that will get impacted the hardest, the quickest, right? Like when we start looking forward and we start talking about this, guys, because we live in Colorado and we understand that our prices are really, really high, this is still the highest price tag for every product in the United States is residential housing. When we start talking about the typical consumer, right? When we start talking about the modern day consumer in the United States, their largest price tag item that they are purchasing is real estate. So when real estate starts sliding, unless people are purchasing, well, what happens? Well, building construction goes down. Your piecemeal people, right? So what happens is we start seeing builders start laying off their workforce. We start seeing the carpenters. We start seeing the tilers. We start seeing the framers. Like these guys start losing their jobs. But here's the thing, guys, this is where we've been living. Here's 2020. Here's COVID, right? The world was coming to an end. And we're not seeing anything major. So we had this recession, we had the COVID recession, the global pandemic, right? World's coming to an end. We saw it dip. And yet we haven't seen anything happen with interest rates as high as they are. And this is why there's no gross negligence on Powell's side. He's like, look, I'm not going to drop rates because people are still employed. And this is the sector they would get impacted the hardest, the quickest, if anything weird were to happen. And keep in mind this, like, I think what's interesting is when we start talking about the housing recession, right? Most of us weren't real estate agents back then. But again, watch The Big Short. That's everyone's homework. And it's always going to be your homework if you haven't watched it. But yet, I think The Big Short is very, very important when we're having conversations, specifically when we're looking to be the real estate economist of choice. When someone said, oh, I'm just going to wait for the housing crash. Oh, we're in a bubble. I'm going to wait for home prices to drop. And yet, here's the thing. let's talk about new builds, right? Let's go, when we're talking about this residential building construction, let's just go specific new build sector, all right? When we're talking about the new build sector, back in the housing recession, they had 1.5 million built homes ready to sell. 1.5 million homes that were completed, that were ready to sell. As they have 500,000 homes nationwide currently. We're talking 1/3 less the inventory on the market just in new builds. So what's going to happen? And we've talked about this, right? And we'll continue to talk about this because I think it's important. This is very important to, I think, get a grasp on this thing to be able to have a conversation. And the conversation is this. New builds are a for-profit company. They have shareholders. And when we look at this, what are they going to do? They are going to turn the spigot down. They are not building on spec. And yes, we talk about this, and there are spec builders, but there's not as many as there were. The way that building happens, and we can see this in Colorado, this is a prime example, and I get that Texas and Florida are a little bit different because they screwed up. They had a let's build it and they will come mentality, and it was gangbusters there for a little bit. But what happens? You go, you pick out your plot of dirt, you give them money, and they say, we'll see you in a year. That's not what it looked like back in the housing recession. The housing recession, they had all this inventory. 3 times as many that we do today, right? 1.5 million homes ready to sell when it was all hitting the fan. And that's why when we had people losing their jobs and their homes were going foreclosure, plus the builders' homes, they were selling at deals just to get them off their books so they could breathe again and pay back the bank. That's why we saw what we saw. We have some of the best balance sheets that we have ever had in our history with the amount of equity that most people have in their home. All right. We're talking hundreds of thousands of dollars that these people have. Think about all the people that bought in the 90s that have not moved. Hundreds of thousands of dollars in equity. Let's say they do lose their job. What happens? Well, they sell it for face value and they move to the Midwest Americas, right? Like that's what this thing looks like. We move to Midwestern United States for a fraction of the cost, cash. Even if they were to do a flash sale, what does a flash sale look like when we're talking about our average price point in the Denver metro? So I'm not talking about median. Median's $600K, but the average price point, $1 million. So I sell my house for $1 million that I bought for $300,000 in the 1990s. Even at a flash sale, I sell it for $900K just to get it done quick. People are not flooding the streets to go pick up a home for $100,000 off at $900,000. Right. So I think that's the thing that we need to keep in mind when we're having these conversations. And this is very important to know is why we're not seeing interest rates lower. And the fact that unless we start seeing more people lose their jobs, which we don't want to see, super anti-American, that if people are not losing their jobs, the Fed is not going to be inclined to lower rates and no one can force them to. This is the only metric that matters right now. So let's go look and see what Logan has to say, right? Logan Motoshami, the lead analyst for Housing Wire, says last week, we witnessed a pivotal moment in mortgage rates and the bond market. And he says this has been, everyone's getting increasingly aware of this with our rising national debt and our deficits. We saw some stuff happen in the bond market, and it says that we could face some consequences because of lack of financial discipline. Yeah, so we're not going to talk about that, but we're being downgraded more so and more so every day for our national debt. It said, yet by this week's end, bond yields rallied and mortgage rates went lower on Friday. And we don't have a whole lot of numbers right now because of the holiday. So most of our numbers are going to be Friday numbers. It says the debt and the deficit story was old news by then, and President Trump's tweet on tariffs against Apple and the European Union prompted the stock market to sell off. Guys, and this is just where we're at. What's unfortunate is this. We have mortgage rates, we have the Fed, and we have we have the president and everything he's going to do. We have the Fed, and then we have the stock market and bond traders. And so I know I just lumped those guys together, but I think it's important. And so what happens is the president says something and a tweet goes out, and then the stock market gets weird. Or we have the Fed presidents, they say something and it gets weird, and then the stock market reacts. And this is why we're in this weird fluctuation where everyone's like, I don't know what tomorrow looks like, because we got threats of tariffs, we got threats of interest rates not moving any, and then we have people reacting and selling stock off. And like, this is just the weird uncertainty that we're in right now. So again, we're not going to talk about the 10-year yield or the treasury, but let's look at purchase application data. Purchase application data, guys, like this is still good news. Yes, it went down from where it was a week ago, but yet we are still above 2024. Again, what this means is this: while there's less people than the week prior, there's still more people than there was this time last year. So that tells us that there's still consumers out there at least finding out what they qualify for. Guys, the story is no longer interest rates are too high. I think that people are comfortable. What we're just looking for at this point are what are the life events, right? We just talked about this, where the 40-year-olds that are getting married, having babies, and need a space to call their own now. Who's in our ecosystem? Look, guys, like these are the people that are talking to lenders, having conversations with lenders to figure out what they qualified for. There are still more people this year than there were last year, and interest rates have not skyrocketed downwards. When we look at this total pending home sales, we're still tracking up, right? Again, like this is what we're going to see. We will see this thing cross 2022. Eventually, we're going to come through this area where this is where interest rates skyrocketed, and then we started seeing some things go down from there. And it wasn't necessarily that they skyrocketed. It was the velocity and the quickness that they did go up is what scared everyone, and everyone pumped the brakes like, oh my God, what's happening? And so when we watch this number will cross here sooner than later. I'm thinking we're probably in June, July, and we will cross. Crystal ball. Weekly pending sales. We're still up, guys. Here's 2024. Here's 2025. Not huge numbers, right? But we still have more pending sales. This is single family. And again, the condo market's weird, right? Especially in Colorado, the condo market is weird, and it's mostly because of our laws around new construction and the statute of limitations that go with it. And so that's why we don't have a lot of single or multifamily like condos. We have more apartments. But even with our condos, what you'll see is high HOAs. And so as we're looking at this thing, we're not putting in the multifamily units, but we're still above on US single family nationwide. Our inventory is still going up. This is a good thing, guys. Being in a balanced market is not bad. Being in a balanced market where we are seeing sellers and buyers come to the table and agree upon a price and terms. But here's the thing: who's listing their home right now? The motivated, right? Especially when we think about the lock-in effect. When we start thinking about those golden handcuffs where people are having their 2 or 3% interest rate, and let's say they don't have any life events. Maybe they're not looking for a change of pace. Maybe they're not looking for lower expenses, right? Where they're looking for going in and they want less taxes. They want to free up some of their equity in their home. And they don't want any of that. They're not having babies. They're not getting married. Well, we still have a population that has a 2% interest rate. And so they're probably going to keep these 3,000, 4,000 square foot home for 2 people Because if they were to leave their house and go right size down to a 2,000 or go down to a 1,000 square foot home for two people, their monthly payment might be the same if they don't have the equity to cover it. So we're going to continue to see this. And so we want to see this come up. And with the motivation, when we see the motivated sellers putting their home on the market, there's a life event that is making them sell well, and there's a buyer that has come to terms with the interest rates and the cost of money. They're going to be at a position where they have a better conversation, which is better for us. Like, we want this to be more of a balanced market, a buyer's market. We don't want to, none of us want a buyer's market. I'll tell you all that right now. And the seller's market was no fun either. The seller's market was no fun because, yes, it was fun to win and get like 1,000 offers and get your client as much money as we possibly could. The unfortunate side was we do know that most sellers become buyers. And so then we were on the other side of this thing fighting for it. And it was not a fun market to be in. New listing data, we're still up here. We're cruising through. We're higher than every previous year, 2022, 2023, 2024, right? We're still bigger here. New listings coming on market, good thing. Price cut percentage, 38%. So again, historically speaking, we know that 33% is the national average. 33% of all homes take a price cut, right? 1/3 of all homes. We're sitting at 38%. 38% just tells me more homes are coming online, and we have motivated people, right? And what happens, right? We know that we have the principle of substitution. Principle of substitution tells us if I got two products like for like, they both serve the same necessity, I'm going to choose the cheaper one. I'm not going to choose the most expensive. So I got 3-bedroom, 2-bath, 3-bedroom, 2-bath, same zip code, same school district, same school district, B plus home, B plus home. I'm going to choose the cheaper one every time. So that's what this tells me. More homes are coming online. Then the second home that comes online is a little bit less in price, or a bigger life event has happened. We see their price come in lower. And so we just start seeing people lower their home values. That's what this is. I don't think this is anything to be concerned about. Jobless claims. Here we are, guys. Like, this is this is the thing. Jobless claims are not getting crazy. And this is your totality of one. We looked at the construction side of things for residential construction earlier. So again, if we're not seeing this thing get weird where a lot of people lose their jobs, we're not going to see interest rates come down. Now, I'm going to say this because I think this is important for all of you to realize as well. Let's say we do go into a recession. All right. Tomorrow we are in a full-blown recession. Now, keep in mind, you guys are all real estate agents in a real estate recession, right? Like, you guys all realize that. And again, certain segments don't have their own recessions. Like, that's not a real thing, but just for a visual purpose, we are in a real estate recession. We're not selling more real estate. We're not expanding. Like, it's pretty flat. The only thing that's driving everything is home prices are up. So real estate commissions aren't truly down. But yet, this is what we need to think about. People start losing their jobs, right, in a recession, because we're coming back inward. We're not spending as much money to increase our business. We're really just trying to stay flat and not go down. So we have two expenses, right? There's only two expenses that most businesses can control. One is their leases. The second one is jobs and employment. Well, leases have contracts. And so unless you want to take a financial hit and go through litigation, like, most people aren't giving up their leases and they're keeping their space. The other one is jobs. So what do people do? They start firing people. They start going down to the bare minimum. Well, here's the thing. We start seeing people get fired. Well, then that's when the Fed is going to react. The Fed will start reacting. And what are they going to do? They're going to start to try to stimulate the economy. How do they stimulate the economy? Well, they make the cost of money less expensive. So they start dropping rates. Well, what happens in that case? Well, you got to figure the more affluent people, the people with job stability, the people that are, holding on, waiting for opportunity, what are they going to do? They're going to start buying houses. So I want you guys all to know that while none of us on this call are rooting for a recession because a recession equals job loss. A recession's not bad for real estate. Actually, a recession's really good for real estate. In the grand scheme of things, if everything tanks, which again, we're not championing, we're not hoping for any of this by any extent of the imagination. But yet, if we were to go into a recession tomorrow, your guys' businesses would get bigger. All of them would, because the cost of money would go down. More people would start raising their hands to go purchase houses. You've been doing the legwork, you've been having the conversations, and you just kind of move forward with things. Just something to keep in mind. So again, we might be at the mercy of crazy headlines and wild moves in the bond market. So for the short trading week, we'll see where the trade war, what that brings us. So that's all we're watching right now. And again, guys, we are at the mercy of what the president says around tariffs. We are at the mercy of what Jerome Powell does with rates. And then whatever they say, whatever they do, the bond traders, they're going to affect a lot of stuff as well. So we just have this group, this triangle of these people shooting shots across the bow at one another. And it's going to impact us either positively or negatively. Most of the time, it's going to be negatively. But let's look at interest rates. Guys, while we have gone up a little bit, this is 1 month's worth of time. And again, this is last Friday's data just because we have a holiday and it takes them that long to catch up for whatever reason. But if we're looking at this thing, again, this isn't bad. I think we're within this room of margin for people's comfort levels to where we're not fluctuating like a roller coaster, because that roller coaster is what scares people. Most sellers become buyers. If I put my home on the market today, it takes 90 days for me to sell my house. What do interest rates look like when I'm ready to lock in? And that's what goes through a lot of people's heads. So then when we're looking at this thing where it stays flat, okay, cool. How do I get in front of that 40-year-old buyer that just got married, that is looking to have children? How do I get in front of those people as the real estate economist of choice? Because interest rates have stayed pretty flat. So what does their moving cadence look like, and how can I be that person to guide them? And let's look at 8.2 through Altos data like we always do. And just like any other indicators, right, we're staying at 710 is our median list price, so stay pretty flat. Then we look at days on market has gone down, and I would say the days on market has probably gone down because the inventory level, the inventory level's gone down a little bit, but not super much. So if we look at days on market average, right, this is what the average versus the median tells me, right? So I'm looking at 54 days on average versus my 35 days median. Average days on market, and when I go over to this price decrease, 52%. All right, so we know historically 1/3 of all homes take a price decrease every year. Nationally speaking, we're at 38%. And then when I look at this, I see 52% lease in 8.2. Well, I go through, the inventory has gone down a little bit, but we're still a little bit elevated. So we're having homes come on the market. We're having more homes come online. More homes are hitting the MLS. We have motivated, because again, the only people that are putting their home on the market right now are the motivated. Life event is putting them in a different direction, whatever that may be. More people in their household, less people in their household. Cost of living, insert whatever here. They are making a life event choice at this point. And so they go through, they have their home on the market, some other home comes online, it's less expensive. Again, what are my only options? I can't market any better, right? I can't just go through and just hold an open house every week and pray that that works. I mean, I don't think that works. So what can I do? Well, I have to be like for like at this point. So both houses look the exact same, all intents and purposes, 3-2, 3-2, same school district, all that stuff. I have to either price myself the same or come underneath them. And that's why we're seeing price decreases. Motivated sellers, more competition. How do I get my home to sell and get more eyes on it? I have to be the cheapest one. That's why we're seeing 52% price decreases. But yet, if I look at this, 54 days, that's the average. All the low homes, all the high homes, days on market, total them up, divide them by the total, 54 days, that's your average. Your median is taking out all the outliers. The 1 day on market versus the 120 day on market gets me 35 days. These are the conversations that we need to be having with our sellers at the dining room table. If we price our home strategically, here's the competition in the neighborhood. We know that we could be 5 days more on market for a 5-day over 1 month time, or we can be closer to 2 months. What does an extra month on market do? Well, you now have an extra mortgage payment potentially. You have more in taxes. You have more in insurance that you're paying. You have all of these things happening. Plus, we don't know what interest rates look like tomorrow. If we price our home strategically based off of what other homes are doing in the area, we have a chance to be on the market for 1 month less. And these are the conversations we should be having. The price increases, guys, this is the thing that I'm telling you about. Like, this is the most fascinating part of the story for me. I told you guys in the beginning, like, I did not care about price increases as it was going up and down and up and down, but now it's flat. Price increases, this is phase 2, phase 3, phase 4 of new builds. What I'm telling you is we have way less new builds on the market. It might feel like we're building like crazy right now, but in the grand scheme of things, we're not. We have 500,000 new builds ready to go in the nation right now versus 1.5 million. 500 versus 1.5 million like we had in the housing recession. New builders are not getting what they wanted to. So what are they doing? They're going to constrict the flow of homes to keep their prices inflated. And they're just going to do a small, slow drip. And they're going to build on spec more and more. Inventory doesn't excite me. Median rent, 3,100 in ALLL2. They give it a market action score of 47, which says, hey, we're in a better seller's market than we were this time last week. So it just tells me we're still in a seller's market.